Risk management can help protect your business against the unexpected. It's the process of controlling and financing losses and minimizing risk. In the previous videos, we learned to identify, measure, and prioritize risk. The next step in the risk management process is to select the right risk treatments, which can help you control losses, manage risk exposures, pay for losses efficiently, avoid fines, and stay on track with your business goals. In this video, we'll learn to manage or control risk and to transfer or retain them. You can turn to your Louisiana Small Business Development Center consultants for help in choosing the right risk treatments. There are 4 main risk treatments: avoidance, retention, control, and transference. Avoidance is never engaging in a particular activity that might incur a loss. For example, if you want to prevent accidents and their accompanying losses, you might avoid driving a vehicle. Obviously, using avoidance to prevent accidents is impractical in doing business. Typically, the avoidance method is not the best method for a business to deal with risk. The next option for risk treatment is retention. Retention is paying for losses out of cash flows, setting aside money to pay for future losses, or sometimes borrowing or liquidating assets to pay for losses. Retention is the most common treatment used by small businesses. When coupled with another risk treatment, control, it's generally the most practical and cost-effective way to manage losses without inhibiting growth. The money spent on insurance premiums can be used for other areas of your business. However, this can be a risky method to use alone when the potential loss is severe or critical. The third risk treatment method is control. This treatment method reduces the size and probability of losses. For example, in order to control your property loss exposure from fires, you might install smoke detectors, purchase fire extinguishers, and institute an escape plan. Just by employing these simple control measures, you could reduce potential property loss, prevent injury and death to employees and customers, thus reducing your workers' comp and liability exposures and avoiding costly business interruptions. Finally, the fourth treatment method is transfer. Buying insurance is a form of transfer because you're transferring the financial consequences of loss to another, such as an insurance company. Other transfer methods include leasing property instead of buying it, using bonded contractors and hiring temps instead of permanent employees to avoid workers' comp, and even incorporating your business, thus transferring personal liability to a corporation. Most situations call for a combination of risk treatments. Let's take a look at how to select the right treatment for each risk. Referring back to video 3, measuring and prioritizing risk, you created a master frequency and severity table where you placed each risk in one of these quadrants. You also classified each risk as insignificant, significant, or critical on a ranking of risk graph. Let's begin with high frequency, high severity loss exposures. For professionals like CPAs, attorneys, doctors, and engineers, the potential for malpractice liability might be high frequency, high severity. They could use the avoidance method and not take on certain cases outside of their area of expertise to avoid malpractice lawsuits. Retailers might avoid operating at certain hours to prevent property loss and workers' comp exposures. A delivery service might want to avoid certain high-traffic routes during rush hours. But every time we avoid a particular situation, we also limit our opportunities to make a profit. So avoidance might not be a practical solution for small businesses. Instead, critical risks generally require a combination of risk treatments. The medical provider could carefully document tests, treatments, and results to control the risk and to reduce the frequency of the loss. They should also purchase malpractice insurance to transfer the legal cost and damages to an insurance company should any lawsuits arise. Let's move on to risks categorized as low frequency, high severity, such as wind, flood, and fire damage to your property, and most liability and business interruption exposures. The best risk treatment for these types of risk is to transfer the loss. This can be done by purchasing an insurance policy, such as a business owner's policy, commonly referred to as a BOP. But that's not enough. High-frequency, low-severity risks should also be controlled, such as installing a fire suppression system, having an exit plan for employees, backing up all data on computers. By employing these control measures, not only do you reduce the frequency and severity of losses, you could also lower your insurance premiums. Any portion of loss not paid by insurance must be retained. So you should save significant cash or liquid investments to be able to meet deductible costs and other items not covered by insurance. Otherwise, your business might experience a business interruption or slowdown and lose customers and profits while you're gathering money to pay for losses. It is important to remember with high severity risk that some might be critical risks that should be carefully controlled. You should exercise control procedures to minimize the frequency and severity of loss, but then transfer the remaining loss. Not doing so could cost you your business. For example, business interruption risks generally fall in the category of critical risk. While these types of risks can be controlled, it is also important that you transfer the loss. High-frequency, low-severity loss exposures might over time be very costly if they happen frequently enough. One such risk might be petty theft by customers or employees. Viewed individually, each theft is small. But added together, uncontrolled shoplifting could cost a business thousands of dollars a year. These types of risks should normally be controlled first, then retained. One way of controlling small theft is to monitor inventory carefully. Security cameras, anti-theft devices, warning signs, as well as an employee training program can be implemented to control shoplifting by customers and inventory shrinkage from employee theft. Some retailers acknowledge that theft is part of the cost of doing business and transfer this cost to customers by raising prices. In some cases, employees have embezzled hundreds or thousands of dollars from a business. This type of employee theft is actually high severity, low frequency, and should be controlled by tracking credit card and sales receipts, keeping and checking inventory records, and periodically auditing books. It should also be transferred by purchasing a crime insurance policy that covers embezzlement, or in some cases requiring that employees or consultants be bonded. It is important to remember high-frequency, low-severity exposures can be significant risk. For example, employee sickness over time can add up to a significant risk, especially if it interrupts your business operations. Most employers retain this risk by giving their employees a certain number of sick days. However, the loss from employee sickness should be controlled by making sure contingency plans are in place. Do you have employees on standby to work should someone call in sick? Do you have up-to-date contact information on your employees? The last category is low-frequency, low-severity loss exposures. These risks might include a short business interruption due to a supplier outage, a minor employee injury, or a small vehicle accident like a fender bender. These risks don't happen often, and the resulting losses can easily be retained, either through savings or cash flows. While appearing to be minor, these types of risks should not be ignored. For example, if you can prevent minor accidents by establishing and communicating safety procedures, you could prevent a significant risk over time. Having redundant suppliers could prevent a supply outage that could interrupt your business operations. For assistance to implement the treatments you've selected, contact your nearest LSBDC office. Keep in mind that you must review your risk treatment methods at least once a year and repeat all these steps every time your business experiences a significant change. Remember, LSBDC consultants can assist you every step of the way with your risk management plan. LSBDC offers risk management and business consulting all at no cost. LSBDC also offers low-cost business training and no-cost business information and resources. To find your nearest center, visit www.lsbdc.org and click the Locate a Center link.